taking stock of all that's going on across the globe then, and you clearly have US crude prices this week that have gained about 8%, 5% intraday trade to about $73.7 a barrel, and that's the third consecutive session of gains that you've seen on fears that Israel could potentially strike Iran's oil industry in retaliation to the ballistic missile that was made for Tehran. But that being said, you've got the US futures looking steady, but overnight the benchmark indices were in the spotlight as well, and you do have a lot of comments as well coming in from the US President Joe Biden talking about the possible Israel retaliation. So digesting all of those comments, we've clearly seen those oil supply fears. It seems to be that the gift nifty as well is indicating that it could be a bit of a tempered start this morning. The Asian markets as well looking a little bit mixed, not including, of course, the Chinese markets, but the rest, for now, it's looking a little bit choppy for the Asian markets. Japanese shares gaining for the second straight day. But Nikunj, just taking stock of what we've witnessed with respect to crude oil prices, the kind of commentary coming in from Joe Biden, is this needs close monitoring?
Sawan, there are three factors which we need to consider. Why we fell, where we are headed, and what we should do next. Now the why is easy to explain, why we fell. One side you were pushed because of geopolitical tensions. Second side, you were buffeted because of China. So the why is easy to understand. What are the extra, is there a fresh round of development in that why? China is shut, so obviously it's all about geopolitics. And that's where I think it's the US President Joe Biden who for the first time has indicated, which nobody was prepared for, discussing Israel striking Iran oil facilities. Which means the US is tilting towards supporting Israel openly. This is something which I don't think markets were prepared for or markets anticipated. What it appeared yesterday and when the initial strikes happened, that it would be a pinprick. But it appears that it could be much more than a pinprick. So on the geopolitical front, that is the second development which is important. That you got comment from US President. Then you look at the global setup. Even though you heard from the US President on possibility of a support to Israel, global financial markets have not gone into any kind of a tailspin. Yes, the bias may be negative, but it's not that Asia has completely fallen apart. It is not that US markets are down, and more importantly, S&P is moving in a measured manner. So that is important. And then you have the US jobs data, which in a sense would be the moving part. So if you analyze the why, there's one fresh development which is a bit of a bother on the oil front. But barring that, I would say it's not a very scary scenario. But what we'll have to discuss is that FI number. I mean, I looked at the FI number both in terms of quantum, in terms of FNO, and also in terms of the impact. And that I think is, I don't know what to say.
Yeah, well, the world has stabilized, but we definitely took a hard knock because of all that was happening across the globe. A 15,000 crore rupee sell figure. Yes, it was mitigated by the DII buying as well, but it was quite a carnage. Let's not sugarcoat the fall yesterday for us.
No, Aisha, that 15,000 crore needs to be added up with that 9,000 crore and another, 5,000 crore. Yeah. So the point is that post, what has changed, Aisha? One assumption. And when the assumption of the market, which was the majority assumption, it changes, it will lead to a painful adjustment, as simple as that. The assumption post the Fed meeting was that money will come to emerging markets and it will only come to India, it will not go to China. Well, guess guys, what the reverse has happened. Money has moved out of India and money has moved into China. This is something which I don't think markets were prepared for. So there is no particular reason why FIs have sold yesterday, barring that the China trade I think is clearly visible. But what really matters are two factors here. The selling has been very intense. It's been very rampant, so to speak. And if I add both cash and FNO, which is important, in cash they were selling, and in FNO they were cutting their long positions, and they were buying, essentially, and they were creating short positions. So the combination of FI selling in the cash market and in the FNO market essentially broke the back of the market. Now, are these ETFs? Is this money moving out of India to China? Is this global readjustment happening? Very difficult to fathom. But the bottom line here is that has been an unexpected barrage of selling which has come from foreign institutional investors. So then you go to pause and say, okay, what's next? Ab kya karne ka? That's the most important point, right? And I think October will be strikingly different from September. There is news, there are earnings, there is MPC. We will be closer to the state elections. Everybody will start talking about, okay, what will happen to the state election outcomes? That entire political narrative will start, which today nobody is talking about it, but 10 days from now, everybody will talk about it. So there would be so much of news which would be thrown at the market that it is very difficult to, in a sense, pinpoint which way things are moving. The good thing here is that there is cash on the sidelines, whether it is DII or whether it is retail. Those folks have cash. So it's not that, if I sell and there is no buyer, there is the last man standing there. But the news and the composition of the events, I think in October is strikingly different from September. And on top of that, you have geopolitics and FI and the China factor. So October will be a difficult month to call, Aisha, because markets are at an elevated level. You will see this news reaction. It could be panic in some case. It could be, overreaction. It may be mild reaction. Difficult to call, but it is not a market where you want to say that, look, I want to be a cowboy and I want to put, my last buck on to trade, so to speak, or to work, so to speak.
Yeah, absolutely. And especially the kind of incessant selling that you had in some of the large caps. I mean, look at a Reliance, that's a 70% delivery. And you had Reliance alone knock off about nearly 4% and that's where it languished for the better part of yesterday's trading session, finally settling in 4% lower. And that was pretty much the case across the board, Nikunj, be it an HDFC Bank, L&T, ICICI Bank, even smaller ones like a Dabur, PFC. Okay, chalo, Dabur was a standalone case. It reacted to its Q2 numbers or updates, but DLF, BPCL, IRCTC, PFC, some of these most fancied mid-cap and large-cap names saw the maximum amount of selling.
See, Aisha, it smacks of a allocation change.
Yeah.
Now that could be technical in nature. That really could be largely because of the China trade which is coming back. I don't think this China trade is a permanent trade, and I don't think the FI selling in India is a permanent trade. Why? Because ultimately India is about rich valuations, China is about cheap valuations. Growth is in India, comfort is in India, attractiveness of pure valuations is in China. But I've always seen that ultimately it's about buying. If you're looking at a macro level, it's about buying visibility rather than buying something which could be cheap and where there is a lot of uncertainty. So I don't think this trade may extend itself. There could be compulsions at play. There are so many verticals and so many vectors which may keep on impacting the market. So difficult to fathom that how long this trade would continue. I'm waiting for China to open on Monday, and let's see where things settle. But yeah, I mean the problem what happens, Aisha, is that markets are still. This market was running on liquidity. And if you see this kind of selling, suddenly a market where everyone thought that liquidity is only going to go one way, the liquidity argument gets dismissed. And that has been the most powerful argument for a market. It was not valuations, it was not great growth, it was always liquidity. And if that argument gets, gets crossed, then you will have to deal with volatility.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.